Well, if we were in government, we'd call this a mid-year economic update and have about 15 letters and make it an annual thing. But it just so happens that today I'm recording with Brian Parker. Brian's the chief economist at ART, Australian Retirement Trust. Friend of the show. I've known Brian for maybe almost 100 years now. Before we get down and dirty, we are recording this on the 8th of July, Tuesday at 11 a.m. So the RBA has not announced anything yet. And it will be going up on the 10th of July, first thing in the morning. So any type of economic episodes that we do, we really want to make sure that they're not sitting in the can for a couple of weeks. So all that to say, this episode is brought to you by Australian Retirement Trust. Thank you for partnering with us, ART. We'll put some details in the show notes if you want to check out what they're doing as part of this episode. I've actually got some questions to ask Brian if there's any relevant updates at ART. You've got a lot of members that listen to this podcast. But welcome back to my shed.
It is great to be here, Glenn. Thank you very much. And thanks for the coffee too. So
my pleasure. Hey, we're halfway through 2025. Has the global economy surprised you so far this year? Has it gone as expected? Is it anything caught you off guard with your economist little cap on? Yeah,
that's a really, really good question. I think from the point of view of the economy, things are sort of playing out the way we thought. But financial markets, I think, have been more surprising. Certainly when Trump announced his tariff proposals on so-called Liberation Day, and the more he spoke, the further down markets went. I think I didn't expect markets to turn around quite that quickly. I certainly didn't expect Donald Trump to change his mind about tariffs quite that quickly, and certainly the speed of the turnaround in share markets, I think, caught most people by surprise. And certainly we did see a number of people very, very concerned during that time, but that concern pretty quickly evaporated when markets just went on a bit of a tear, and so we ended up, finishing the financial year very strongly. And I think that's got to be counted as the biggest surprise. The tariffs are not really a surprise. We kind of expected that Donald Trump would follow through on his tariff proposals. We didn't obviously have any idea what the exact nature of them would be, but we knew they'd be bad. And it's still not clear just how bad they're going to be. There's still an awful lot of uncertainty about what tariffs are going to apply to which countries. There's still negotiations going on. So at time of recording, we really don't have any clarity yet about what US trade policy looks like.
We just do know at the time of recording, just over the last 12 hours, Taco Trump, and I'll tell everyone what that means if they're not online and all that like I am. Well, it's Trump always chickens out. That's the saying that the kids are saying online. But they've kicked the tariff extension down the road till 1st of August to give more time for countries to negotiate. There was a few hard changes of some other countries, but broadly it's a bit of a non-event, and markets didn't really react, like maybe down 0.7 or 8 overnight in the US.
Yeah, it's certainly nothing like the Liberation Day sell-off. So I think the S&P was, as I said, down about 1% or less. So it wasn't as bad as the reaction we've seen previously. But there's still just no clarity. I mean, this idea that you could deliver 90 trade agreements in 90 days was always a bit of a furphy. And also a trade agreement is not a two-page flyer. I think there's also this idea that somehow, a two-page fact sheet somehow counts as a trade agreement. That's just not the way trade works. So he may well come up with a bunch of so-called agreements over the coming weeks, but they're not really going to contain a hell of a lot of detail. Because you can't do it because you can't really go through the detail that trade agreements require in the time that he's allowed, really.
And I think the reading that I'm reading, or the data or stuff that I consume as a person out in life, probably like AFR stuff, maybe some US stuff, but particularly as Australia stands, we've still got this imposed 10% baseline tariff. If you are new to this podcast and all that, maybe just a quick recap of how a tariff works
Yeah, so a tariff is a tax on imports. And so basically if you're worried about the amount of imports coming into your economy, one way you can address that is you can impose a tax on imports so that it increases the price of imports relative to, say, domestically produced substitutes. So in theory, you should reduce the demand for imports, make your domestic products more attractive. What it also means is the consumers pay that tax. So the end customer pays the tax. The foreign country that supplies the imports, they don't pay the tax. It's basically a tax on consumers at the end of the day.
Yeah, awesome. A couple of things that people might, want to know or discuss. Anytime we talk about, we've got an economist coming on, there's a big difference between the economy and Economics 101 and actual financial markets.
Very
like
much
the share
so,
market
yeah.
isn't the economy.
Yeah, that's a good one. That's a really
Or how do they do they correlate? Is there
Not really. The way I tend to think about it is that the share market, or at least the businesses that comprise the share market, some of those businesses certainly do reflect, and the performance of those businesses is absolutely impacted by what's happening in the economy, and that's great. But other businesses, in the case of Australia, say, for example, our big mining companies, they're much more influenced by what's happening in the global economy and particularly what's happening in China, for example. So you could have a situation where the Australian economy might be quite weak, but the major resource companies that are big players on our share market could actually still be doing very, very well. The other thing too is lags. It's also important to remember that financial markets are inherently forward-looking. They're more forward-looking than any economist or analyst or journalist or any piece of economic data out there. So, markets are interested not on what's happened last week or last month. They're more interested in what they think is going to happen in the future. And in particular, what's going to happen to corporate profits in the future. That's fundamentally what they're on about.
Yeah, and I think like this whole one of the biggest issues that I see because the share market is basically companies that are listed that the public can buy. If there is someone in an office like the president or the prime minister or any political party, and they start moving things around and moving goalposts like we are seeing from the White House, that can really impact confidence, which means if I'm a business owner, well, I might want to just hold my cash a little bit more and not invest because the goalposts might change.
Yeah, very much so. And I think the best way to think about the US at the minute and what the impact of this trade uncertainty is doing to the economy is that, if I'm a business owner and I need to allocate capital, I need to make long-term capital spending decisions. And as part of that, I need to make decisions about, am I going to produce stuff in my own economy, or am I going to source imports? Am I going to get stuff produced for me offshore, or am I going to get stuff produced for me domestically? And in order to make those decisions, I need to know what the rules of the game are when it comes to trade. And right now, it's not clear what the rules of the game are. And so consequently, there is a risk, even though the US economy is actually holding up remarkably well so far, there is a risk that this kind of trade uncertainty starts to impact not just confidence, but actually hard spending decisions. Right now, that's not happening, but the longer this uncertainty goes on, the greater the risk is that business investment decisions start getting put on hold. And that does raise the risk that you get a recession at some point in the next year or two.
Yeah, well, there you go. We're going to continue this discussion. My name is Glen James, joined by Brian Parker from ART, and this is Money, Money, Money. You're listening to Money, 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 or as the regulars like to call us, M3. Everything discussed on the podcast is general advice only, which I'm licensed to give, and details can be found in the show notes. My name's Glen James, former financial advisor, now podcaster. I host this show and a show called Retire Right. I've also got a book called The Quick Start Guide to Investing, which you can check out wherever good books are sold, or there's a link in the show notes. Otherwise, thanks so much for listening today. Now on with the show. Okay. The last couple of years, inflation, central banks, interest rates, it's been a huge deal. And you could probably speak broadly more to Australia. Is our central bank winning the inflation fight? They just kicking cans down the road? Where were we at? And I will say, At the time of recording on the 8th of July at 2:30 this afternoon, there is a RBA board meeting, and we will know if they have moved or reduced the official cash rate. It's currently sitting at 3.85. Brian, there is chatter out there that there may be a drop of 0.25.
Yeah, certainly the market consensus and market pricing is heavily in favour of a 25 basis point reduction to 3.6. And I think at a time like this, you'd have to say where there's smoke, there's fire. So, certainly that's what markets are expecting this afternoon. Certainly the timing of our recording isn't ideal, but I think that I think one thing you can say is that if rates don't go down this month, then you are still likely to see further rate cuts over the coming months.
When, central banks reduce interest rates, sure, that's great if I've got a mortgage.
Correct.
Because I'll effectively pay less. Not as great if I've got cash savings because I won't get a higher interest rate. But should we be jumping up and down at a structural level if a reserve bank is reducing rates? Because that could be a warning sign of, well, things need stimulating and moving.
It's a good way of thinking about it. It depends on the level you're starting from.
Right.
I think right now it's safe to say that the economy is holding up okay. The private sector is still quite weak. So measures of private sector demand are still pretty anemic. And so the private sector probably needs a little bit of a boost. The fact that inflation has come down considerably, they have made excellent progress in bringing inflation down. They're not 100% out of the woods yet, but I think from the Reserve Bank's point of view, it's a bit of a balance of risks. Do you wait too long and actually end up having to cut rates further because the economy ends up being weaker than you thought? Or do you give inflation the benefit of the doubt? And do you say, look, I've made enough progress. I'm now more confident that I can keep inflation in line with target. Therefore, I'm going to cut interest rates in advance of that. And, you've got to be careful what you wish for. If you sort of think, I think interest rates are going to come down by another 2 or 3%, in order for that to happen, you'd have a very, very weak economy. That would be pretty much recession territory. So right now, I think it's a case of we've made progress, the economy needs a bit of a boost, and so we're going to cut interest rates another time. And that will certainly help consumer spending. It'll certainly help borrowing decisions. So it will provide a bit of a boost to the private sector at the margin. But you're right, if you're relying on bank deposits for your income, it does mean that you're getting a cut in your income as well.
Actually, in the Facebook group, because I did ask people to put questions up if they wanted to chat, Aidan actually said, why is the only lever the government has to address inflation is to increase interest rates, i.e. when bills are getting higher, all we can do is increase another bill?
Yeah, that's a really good way of putting it. And certainly higher interest rates does inflict pain. And, the interest rate lever is really the only in reality, it's the only effective tool governments are willing to operate. In theory, a government could actually come out and say, you know what, we need to rein in spending, we need to tighten things up a bit, so we're going to cut spending and raise taxes. Governments are notoriously unwilling to do that. And so consequently, because governments are not terribly good at using tax and spending decisions to rein in inflation, so much of the burden falls on the central bank to make these kind of tough decisions. Michelle Bullock actually put it well when she said, look, I know high interest rates hurt some people, and she absolutely got that, but she said higher inflation hurts everybody. And I think that's a good way of putting it.
Yeah, that's very interesting. How exposed is Australia right now, particularly around China, or are we actually resilient? Because remember, maybe even 15, 20 years ago, China's growth was like 11% a year or something, and it had slowed down. Like, what's the relationship as it stands at the moment between the stuff we sell to China and the prosperity of Australia?
Yeah, look, there's still obviously, what happens in China and in Asia more broadly is a key driver of Australia's export performance and a key driver of our national income. Let's broaden the discussion a tiny bit because it's useful to talk about our relationship with China in the context of the whole Trump tariffs and trade wars and all the rest of it. Because clearly China is well and truly in the sights of the US when it comes to trade. And, if the tariff measures that Trump ends up imposing, if they were to severely hurt the Chinese economy, that is not great for us because by implication it means it's going to impact Australia's exports. However, the flip side of that is that if you were to see a significant effect on the Chinese economy, it's highly likely that the Chinese government would throw money at the problem. They would stimulate the economy pretty aggressively to try and mitigate the impact. That tends to be good for us. So what it means is that if you think about the impact of Trump's tariffs on Australia, it's likely to be relatively small and relatively short-lived. Because of that, impact on China is going to be mitigated by government spending and other measures to boost Chinese growth, but also our exports to the US, even the direct impact of tariffs isn't really that significant. The US only accounts for, it's a single-digit percentage of our exports. So if you whack on a 10% tariff on our exports to the US, it's not really going to be a killer punch for Australia's economy. And a lot of what we export to the US is commodities that we can redirect elsewhere anyway. So it's not that big a deal for us. But certainly the impact on China is a more important channel for us.
Do you think, and you'd obviously read other economists' opinion and views, where are, Australia right now, forget the absolute housing affordability crisis, but as an economy with our debt to GDP, spending and all that, do you think Australia is living in its best days, worst? Is there
it's a good
better to come, worse to come?
I think that we've got a lot of opportunities. I think I would count myself as a medium to long-term optimist about Australia. And let me outline a few things. One is, in a world of geopolitical uncertainty and political uncertainty, our political system is relatively robust. And I think that's a powerful advantage. I think that we are likely to benefit significantly from our resource base over the coming. We already have, obviously, via the boom in iron ore, et cetera, and the boom in China. But if you think about addressing climate change, for example, the solutions to climate change are actually very resource intensive. If you want to facilitate a transition in the way the world produces energy, that's going to require a hell of a lot of metal, and it's a lot of metal that we can supply. We're also a lower risk supplier of a whole range of rare earth metals, for example, that currently come from China. So certainly we're a beneficiary of these sort of geopolitical shifts that are taking place. We do need to get some decisions right. We need to get our own climate policy right. We have to facilitate our own energy transition. We've got to get our water policy right. But I think that I still count myself as an optimist on Australia's longer-term future.
And surely that, this is not really – it's a political statement because I'm literally going to state something political, but it's not a view of who's the better party or whatnot. But, the Labor government have just been voted back in recently. Yep. There's probably another 6 years, another 2 terms in the bag if they don't stuff something up. That's got to be good for Australia to actually get some stuff done because we've got continuity of government.
It's interesting. I actually think that
I guess it depends if you like the stuff that they're doing.
Well, that's the thing, and also I just think that one thing we've learned from politics globally and here in Australia is that if you think you've got 2 terms in the bag, that is a very, very dangerous mindset because certainly we've seen, certainly at the state level, governments thrown out after 1 term that had a large majority. Queensland being a case in point in relatively recent history where, Campbell Newman was the Premier and he just lasted 1 term and Labor came back from near oblivion to win state government in Queensland. So in politics, complacency is death. But one thing I would say, though, is that if you think about the broad positioning of economic policy, how governments run fiscal policy and how monetary policy is run, that doesn't really change dramatically depending on the colour of the political party in office. There's remarkably little difference in terms of macroeconomic policy settings under either side of politics. You can argue, certainly you can look at things like climate policy, for example, and yes, there has been significant differences over recent history. But in terms of the broad macro settings, it's not that's why, from my perspective, I, as an economist working for a major super fund, I don't really pay a lot of attention to what's happening in federal elections because it doesn't really change investment strategy or our long-term views of the world.
Yeah. And I think it's really important to note that if you step back and the budget episode I did earlier in this year when I talked with someone at the AFR, I think Mike Reid, we just literally just looked at the Treasury numbers to see the debt, the expenses and the deficit, remove whatever political party is, and that gives you the real facts of what's happening.
Yeah, and one thing that's pretty clear, firstly in Australia, if you look at our debt and our public debt, our government debt and the size of our budget deficit, is it ideal that we don't really have a balanced budget at this point, or that we still have a structural issue with our budget deficit? That's certainly less than ideal, but we're not on our Pat Malone. If you look at most other comparable economies or most of the major developed economies, pretty much all of whom have or are running larger budget deficits than we are and have larger or higher levels of public debt than we do. So when it comes to, if I'm a global investor and I'm looking at sovereign debt risk, I'm looking at the magnitude of fiscal imbalances, for want of a better description, around the world, Australia doesn't really doesn't ring anywhere near the kind of alarm bells that you might get in the US or elsewhere.
Moving to housing affordability, I mean, my own type of view is if you're a younger Australian and you want to buy a house, even we're in Newcastle at the moment, I was looking at a suburb just up the hill, suburb called Garden Suburb. I was just randomly looking on that online the other day. It's 800 to 1.1 to knock on the door, right?
Yeah.
Now, if someone was closer to a major city or in an area where they needed 1.2 million to buy their first home, even if housing prices fell 15%, that younger Australian, their problems don't go away, because whether it's a million or 1.2 for most people, it's a non-starter at the moment. So what's the deal with housing in Australia, and what have you seen that the government is actually doing about it? My own kind of anecdotal vibe when I look at this, all governments now are actually talking about the supply issue.
Yeah.
Where there was a period of years where they were trying to blame tax, trying to blame everything else, not actually going, no, it's actually a supply issue. So where are we, is this just the new normal? Because I think if you're saving to get your first home, all the stuff the government's doing, this problem isn't solved in 3 years.
No, it's not. And I think governments are right. It's been a long time coming, but you're finally starting to see governments start to talk more about supply and start to move on increasing supply and making it easier to build new supply. Unfortunately, a lot of this is very much out of control of the federal government, given that a lot of these sort of decisions tend to be very much state and local based. And certainly, when I talk for my sins to people who work in the building trade and some friends who are architects, and what some of them say about dealing with certain local governments is frankly not fit to print. There is certainly more we could do to make more supply easier, make it easier to build more supply, because that's certainly what we need. We're short of homes quite dramatically, but you're right, we can't solve this problem in 3 years. The other angle I'd say is that when you look at the overall data on first home buyers, the percentage of new loans going to first home buyers, it's not exactly ridiculously high, but it's not historically low either. It's about average, which says that there are clearly first home buyers out there that are able to buy, but herein lies the problem. Your ability to be a first home buyer depends on the genetic lottery of life. If you have the right parents or grandparents or both, then you're a perfectly credible first home buyer. If you don't have the right parents or grandparents, then your hope of buying a new home, your first home, certainly within cooey of a major city, is pretty remote indeed. And it's pretty tragic that that's the kind of country we've become, where your ability to be a homeowner depends on who your parents were or who your parents are. The other story here is the rental market. What can we do to boost supply in the rental market, and in particular to change the dynamics of the rental market? for example, if I had a young family and I was renting, and the best I could do was a 6 or 12-month lease, and I've got kids of school age, does this mean I'm potentially going to have to move schools every 12 months at the whim of a landlord? So giving people more security of tenure through the ability to sign longer-term leases, or maybe, and I think we're seeing some more discussion about this, institutionalising the ownership of rental property. So that rather than having a private landlord making decisions that can affect your security of tenure, you might have a large institution or a corporate entity that actually owns a block of rental apartments.
Has ART, with your ART hat on, has there been chatter of ART buying an apartment building and just literally building one from scratch, and the super fund owns it, and that's part of the investing pool of
We've
the
certainly
member
looked
assets?
at it, but in Australia we found it very, very hard to stack up.
Right.
At the end of the day, it's not the responsibility of ART or its members to make up for decades of government failure in housing policy. But, if there was a way that we could help increase the supply of rental property and still generate an attractive commercial rate of return, we'd absolutely look at that. But certainly, and give you an example, in the United States, where we absolutely invest in what's called multifamily residential, where an institution or pool of capital owns a might be a fairly large development where all the houses or apartments are built to rent. And that means it gives people security of tenure, long-term leases, etc. It means that the owner can invest and maintain the property more easily. So there is a scope for that internationally. It's a fairly major
But it's just the
asset class.
cost of investment in Australia.
Yeah, and a lot of it comes down to land values, especially in our major cities, and the cost of building, and also the tax system. So housing being GST exempt, but you still have to pay GST on the building cost, for example. So we certainly we have done. We've dipped our toe in the water in social housing by providing some debt funding to a development in Queensland. But that was in partnership with the Queensland government to sort of underwrite a big chunk of the risk involved. So we'd certainly look at we're absolutely willing to look at investment opportunities. But as I said, it's got to be in the members' best financial interests. It's got to deliver a commercial rate of return. The discussion is ongoing, but certainly we haven't been active in that space just yet.
Does ART have a view on whether the government should allow people to take money out of their super fund to put into a first home?
I think the way I would describe it is it's any measure where you put more money into people's pockets so that they can pay for home. All you're doing is boosting demand. We've tried this for decades with first homeowners grants and the like. All you end up doing is increasing demand for housing, forcing prices up further. And the way it ends up working is that you end up with an indirect transfer of wealth from your retirement fund to the vendor of the property. Unless you do something about supply, we're going to be in this same merry-go-round. I just think that measures to boost demand, the definition of insanity is doing the same thing over and over again, expecting a different result. Demand measures have actually made the problem worse on balance over the last 20 years plus. And so we've got to do something to address supply, really.
So you're a distinguished economist and gentleman.
Kind of you to say.
Well, you're welcome. You've got children probably in around that first home.
Yeah, absolutely.
What's the discussions that you're having with them, knowing that you've got a seat at the economic table, as in you totally are across what's happening on a family front? Like, what are the discussions been like with your kids?
Well, I think they are certainly in that boat. My daughter is 25, my son is 23, and they are actually saving because they want to get on the property ladder, absolutely. My wife and I both said that we are simply going to have to help them out as much as we can without jeopardising our own long-term retirement. That's retirement future. But certainly I think my children they're better placed than many, but they're certainly aware that it's going to be a struggle for them to get their first home. And they're having a good go at it.
Yeah.
These conversations are live. There's another way of thinking about this too. I think we might have talked about this in a previous call too, Glenn, that the political appetite to do something about it depends on the views of the median voter. What does a typical voter want politicians to do? And unfortunately, the median or typical voter out there is at this stage not a renter. They are either paying off a home or they own their home. And so the median voter is very, very wary of any policy that is actually going to potentially drive down the value of their property. And even when you look at our political class, we look at it where our politicians invest their money, a lot of them are landlords, and that's both sides of politics. And so until that political dynamic shifts, it perhaps means that progress towards doing something about this is going to be slower than we'd like.
We might take a break. When we get back, we'll talk about tax, because what is more sexy than tax? Don't answer that, anyone. We'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au, and they'll point you in the right direction.
Okay, we're back. If you want to join the discussion in the Facebook group, because there's a couple of questions here that we will read if we haven't kind of covered them. When you join the Facebook group, just put where it asks, where did you hear about this? Put episode 8, whatever. I heard Glenn and Brian on the podcast, because then we know you are not spam. Okay, so in light of the government's huge majority, landslide, before the election, I don't know if I heard the two words tax reform at all leave the mouth of anyone, but that's on the table now.
Yes.
Is that a fair, I don't know if I heard it that much.
No, it really wasn't. And I think it does highlight the fact that, politicians generally are very, very cautious about dealing with tax in election campaigns because it's just very, very hard, if not impossible, to have a sensible debate about tax policy even at the best of times. And the best of times is not during an election campaign.
Yeah.
And that's really sad, because that's when we should be talking about this. But sadly, the standard of debate just isn't at that level. But is there a need to talk about tax and need to talk about how the government raises revenue? Yes, there is. So I applaud the Treasurer for at least starting the conversation.
Yeah, I might reach out to the Treasurer or my contacts in Canberra, and I don't know if he's actually willing to come out and sell what he wants to do yet to, the average bear like me. But I'm going to see if I can actually do an episode on what he wants to do and why. But one of the biggest things that we have seen is it's been put on the table, the GST increase. Now, for right or wrong, and the YouTube comments will obviously correct me. How dare I post a video on YouTube and not be corrected? For a long time, I've said we do need to increase the GST, probably increase welfare, and probably increase, tax-free thresholds to kind of balance all that. And there's always a million reasons on why it won't work. But so the GST is currently at 10%. I'll get you to explain kind of the change to the GST, when it was introduced in the early 2000s, why they did that. But just so, if you've ever travelled to London or the UK, everyone, you'll get the receipt and it'll say VAT. So VAT is the value added tax, which is basically the GST. Here are some economies around the world, and I literally just typed this into chat while we were chatting, so it could be wrong. The problem with AI and ChatGPT, everyone, if you do not know your subject matter expert, it will lead. If you don't know your subject matter and you're not an expert, you can't rely on this stuff because it will trip you out because there's a lot of errors in it. Australia's 10%, so that's correct. It says here New Zealand's 15%, UK 20%, Canada, it's a province thing, but by 5 to 15%. Germany's 19%, France 20%, Italy 22%, Spain 21%, Netherlands 21%, Sweden 25%, and on it goes. So we are, as a GST, in the lower quartile, if you want to call it. As an economist, what's your view on increasing GST and making our society more of a, we pay tax on what we consume rather, because I think there's most of the heavy lifting on the federal budget is done by income tax. And we know we've got an older ageing population.
Yeah, look, I think firstly, I just don't see any great political appetite to do anything about and the way the GST was structured, with the revenue actually going to the states technically, to actually get a GST increase through would be extraordinarily difficult. And there's no magic number. And certainly, I'm old enough to remember the debates about when the GST was introduced in the early 2000s. And one of the criticisms was wherever it's been introduced, it never stays at its initial rate. It always increases. So to counter that, John Howard and Peter Costello designed a system where it was almost impossible to increase. And so are there other things you can do on this tax side of things to maybe make the system more efficient? Now, this is not an ART view and it's not a Brian Parker view, but certainly when you talk to tax specialists about this, certainly things like land tax is something that tax theorists would say is actually a very, very efficient tax. It's much more efficient than stamp duty, for example. So there are things you can do. There's also some very sort of the sacred cows in Australia, for example, like negative gearing. To try and even limit that, let alone eliminate it, would be extraordinarily difficult. It wouldn't really make a hell of a lot of difference anyway. But I think more broadly, we need to have a debate about, it's not just tax, it's also about, well, what do you want the government to actually do? What tasks do you want governments to do? And I think there is an education challenge here that politicians need to go through, where to tell people, look, this is what governments do for you. This is what the people have said that we want governments to do. We want the government to fund an adequate health and education system. We want the government to fund the NDIS. That is proven to be a valuable national asset for many very vulnerable people. So if you want the government to do all these things, and you want the government to buy submarines down the track, if people want that, well, how's it all going to be paid for? And so that means we need to ensure that our tax base is kind of robust enough to be able to pay for what we want governments to do longer term. Exactly what that looks like in terms of how much do we raise through the GST, how much do we raise through things like, new taxes like a land tax or income and corporate tax, is really an open question. I don't have a strong view on it because I'm a humble macroeconomist, not a tax specialist. But it is certainly a source of frustration that we've trained a generation of people that whenever you hear the words tax reform, people think, oh, good, how much am I going to get back?
Yes,
and that's not the right answer.
Yeah.
It's more about, well, who's going to pay for what we want governments to do and how they're going to pay for it.
Ken Henry did a really big tax review in 2010 called the Henry Tax Review. In 2014, he described a future GST increase as inevitable, but it says here more recently in 2025, he reiterated that it's possible to achieve major tax reform without necessarily increasing the GST or extending its base. Such measures should not be off the table. So I think you're right there. As a society, it's always been tax, how much can I save?
Exactly.
Tax, how much can I get
That's
back?
right.
And I just think, as you said, if we want all this stuff,
Someone's got to pay for it.
The money's got to come from somewhere. And I think the biggest issue is, well, someone might say, well, we'll just grow the pie. Well, if we grow the pie, we're going to need more migration, and that's just going to screw housing prices more because there's going to be more people.
Yeah, and at the end of the day, it's a delicate balancing act. Yes, we need, fundamentally, the long-term growth in the economy is labour force growth plus productivity growth.
Yep.
That's the math. And so you get your labour force from somewhere. People who are you get it through the birth rate and you get it through migration. But at the same time, you need to have a strong housing policy to ensure that you're going to be building enough homes and building homes and apartments in the places where people want to live and work so that you can actually have a functioning and efficient society.
And also the infrastructure, which
correct.
Is pretty useless a lot of the time at the moment. You mentioned the P word. I wrote it down before. Productivity. What do people mean and governments mean when it's like we need to get productivity up?
Yeah, if you look at Australia's, and productivity is basically output per unit of labour. It's technically it's output per hour worked.
Yeah. So we want everyone to do 1.5 widgets per person now.
Instead of one widget. That's right. Now, how do you do that? It's not increasing your hours work. That's not productivity. It's about working better and smarter and more efficiently. Now, increasing productivity, there's no magic wand and there's no one tick box you can tick that is going to increase productivity over the next 6 months. This is a longer-term strategy, a longer-term objective. And there's a whole litany of things you can do. You can do things in terms of business regulation. You can do things in terms of workplace, how we structure our workplaces. That's obviously a very controversial area, and it does vary a lot from industry to industry. Better utilisation of technology, a better education system, better skills training for the workforce. There's a whole list of things that people talk about when it comes to boosting productivity, all of which are going to make some contribution, but there is no one-size-fits-all solution to this. Fundamentally, if you look at the very, 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 very long term, typically Australia's productivity growth has averaged somewhere north of 1% per annum. It's not grown hardly at all in the last decade. Some industries have done considerably better than others. So you've things like communications and IT where you've seen quite strong productivity growth. But in other sectors, mining, construction, parts of manufacturing, you've seen productivity go backwards. There is no one size fits all, but there's a laundry list of things you could do to boost productivity over the longer term.
Let's quickly talk. I'm going to ask you about the Div 296. Then we'll just go over these listener questions. Then maybe you can tell us where we're at with ART, any updates from your side of the table.
Sure.
But just while you were talking there, there hasn't been much chatter at the moment on the Div 296. I was just looking up what's the latest. I think within the last 24 hours, there's a Daily Telegraph article, Liberal elder blasts Labor's troubling super tax. So Labor's troubling super tax on unrealised gains and wealthy super balances has united political leaders from both sides, with Philip Ruddock backing Paul Keating on the issue. So there's a few elder statesmen out there coming out to say this is bonkers, but Chalmers seems to be hell-bent on putting it to bed. But yeah, at the moment, I think I guess when Parliament comes back and bills are tabled, the discussion will increase again. But so far, it seems like it will be put to bed. Do you have a view, either as an economist or as ART?
Yeah, ART's view is that we don't have a big problem with it. You basically you're affecting a relatively small number of people. So a relatively small number of people in the tens of thousands, not hundreds of thousands, are going to pay modestly more tax each year on their returns on balances above $3 million. The bigger issue, though, for us is the indexation. So we would support either indexing that $3 million cap or put in place some other kind of review mechanism so that cap is reviewed over time. Because even though the future is inherently unknowable, it may affect relatively few people today, but it may end up in 15, 20, 30 years' time impacting a much higher percentage of people than you would otherwise like. And so some kind of indexation mechanism to us makes sense. This is also part of a broader issue too, is that if you think back, some of the major tax changes that were introduced in the mid-2000s, abolishing reasonable benefit limits, for example, and the changes introduced by Peter Costello, over the subsequent 20-something years, governments of both political persuasions have sought to claw that back because the magnitude of those tax concessions on super have basically gone too far. And so, in other words, if you think super is meant to basically save the government's budget by meaning that we're less, people will be less reliant on the pension, if you've got to give away so much tax in order to facilitate that, well, it defeats the purpose. And so to the extent that those massive super giveaways of 20-odd years ago are being wound back, that is no bad thing. You can argue about each individual measure, but certainly, is there a need perhaps to make the system somewhat fairer? I think we would all support measures that would be making the system fairer. Yeah. Whether this is exactly the right one or exactly the right mechanism, I don't have a strong view, but
I'm not of the view that the slippery slope that they're going to turn around and tax unrealised gains in ordinary money outside super.
No, I don't see that at all. No.
I'm not of that. And there's going to be slippery slope people and all that stuff that I just...
I think that's always the... This really does highlight the problem of any debate about tax.
Yeah.
That even incremental change, people say it's a slippery slope.
Yeah.
And it's like, sorry, that's a slogan, not a policy. Surely we can be a bit more constructive when it comes to tax than just talking about slippery slopes and running kind of scare campaigns on that basis.
Yeah.
We do need to make the system fairer. We do need to raise a bit more money to fund what the government needs to do, what we want the government to do. So, as I said, we don't have a major problem with it, but we would like to see some form of indexation or review mechanism.
And you would have members with balances over that amount?
Very few. If you think about it, we have relatively few members with those sort of balances. In fact, I think the last number I saw was either 60 or 80,000 people right now that actually have super above $3 million. We're talking about very, very few people.
Yeah.
And so in our membership, our members tend to be relatively young. The average age, I think, is about 40 to 45. Most of them are not going to be within cooey of $3 million.
I saw there was a report a few weeks or months ago on ABC, I think it was on 7:30 with, excuse me, they talked about a farming family and how this was impacting, but it didn't actually sound at all like the farm was owned by the self-managed super fund. They just had a self-managed super fund with other assets invested. And I think if you have a self-managed super fund, as a trustee, you have liquidity responsibilities.
Yes.
If you had a self-managed super fund with one farm in it, with 4 members, you might have a bigger issue.
I wouldn't say that's a diversified portfolio.
No, but you may have a bigger issue if one of the members dies or if there's only 1 or 2 members in there and one dies and their member benefit needs to be wound up. So sure, there's some paperwork and all that, but there could be bigger issues than Div 296 if you've got a whopping big asset in your self-managed super fund. That's what I'll say. So in finishing, and thanks, Brian,
great pleasure.
We did have some questions here, but as you said, I've pretty much gone off script.
We've always just kind of wing it.
If you're seeing on YouTube, there's all these people with all my pre-planned questions, but in true form, we've gone off script. We've talked. I'm just going to do a recap. I think we've covered most of the stuff that people have asked in the Facebook group, but what's the latest at ART?
Look, we've had a pretty good year actually. Certainly over the year to June, if I think about most of our members tend to be in our default option, our life cycle option, which means that if you're under the age of 50, you're in our high growth option. Over the age of 50, you get transitioned into a balanced portfolio. Both of those portfolios have delivered double-digit returns for the year to June and very, very competitive returns as well. So it's been a very, very pleasing period in an ART sense. But more broadly, if you think about the last 12 months, ongoing war in Ukraine, conflict in the Middle East, the Trump tariffs, the continued uncertainty over trade policy. There's a whole litany of things we could worry about. But as someone said the other day, there's an old adage that share markets climb a wall of worry, and that's exactly what they've done. That you've seen, you've seen very, very strong share market returns, not just here in Australia, but globally. I mean, better than 13%, 13.7%, I think, for Australian equities for the year to June, which is extraordinarily strong returns. in a world which has been a very, very volatile and uncertain place. Now, that doesn't mean we're out of the woods. It doesn't mean the next year is going to be equally brilliant. We frankly don't know. But certainly you've seen very, very strong returns. There's a reminder, I think, in the last year. Firstly, the speed with which share markets turned around after Liberation Day just highlights how inherently unpredictable these short-term market moves are, especially in a superannuation fund context. And one thing I often tell members and tell corporate clients who represent their members with us, we can't design portfolios based on our ability or anybody's ability to forecast the short term. We certainly can't forecast what's going to come out of Donald Trump's mouth in any given week and what US trade policy is going to look like in the next week or let alone the next 12 months. And so our job is to stay focused on the longer term, try and take advantage of market volatility that comes our way. So the opportunity to buy cheap assets, to take advantage of dislocation. We've certainly seen plenty of opportunities to do that. But really just focus on delivering the kind of long-term investment returns our members need. That's the job of any super fund.
Have you guys purchased any big stuff lately?
So one of the things we did during the year, we actually put some more money into renewable energy in the United States, which you might think is a bit of problematic given Donald Trump's attitude to climate change in general and renewables in particular. But one of the things we found with the United States,
no one can outlive progress.
That's true.
Like
that is true. And what
he's only going to be around for less than 4 years.
3.5 years, exactly. But also what we find is that a lot of the US is the biggest, most dynamic economy in the world. And it still has enormous investment opportunity there. So we've got to be very careful about distinguishing between the US as a political system and the US as an investment destination. Sometimes the two overlap, but often they don't. And renewables is the case where we can invest there because the regulatory environment is very much determined at the state and local level.
Right.
And a lot of these state and local administrations, they like the investment and they like the jobs. So they're very pro-renewable.
So if you invest in a heap of renewable stuff in the US, does that sit in international infrastructure?
Infrastructure, yes.
Yeah.
So that would sit in our infrastructure portfolio.
Yeah. And unhedged?
No, we would hedge it.
Okay. Interesting.
Yes. Generally speaking, our private assets are all hedged back to the Australian dollar.
Sure. Okay.
Yeah. We fundamentally want to earn the interest or earn the rent or earn the income stream. We don't want the currency upsetting that.
But most of the international equity exposure would be unhedged?
A fair chunk would be unhedged, but we also hedge part. So we partly hedge,
because you want some
unhedged.
Exposure to currency.
We do
part
want
of the
currency
diversification.
Correct, you do. Because one thing we've seen is that when share markets go through a really tough period, the Australian dollar tends to sink like a stone, and that tends to boost the value of your overseas investment. So you certainly, at this stage, you certainly want to have some foreign currency exposure as part of your broad diversified strategy.
We've just seen the SG increase arrive at 12%, and that's where it stops. There's no more legislation. There's a little bit of chatter online that some pundits want it to 15, but in the main, 12 is probably more than enough for most people. Any, final comments on that? And I've probably got a question to ask you. What to do as an investor?
Yeah, look, and again, the short answer is it depends on your phase of life, your financial goals, your appetite for risk. Everybody's different. There's no one-size-fits-all solution. Often what I'll say to people is, look, if you're doing something with money, anything, not just your super, just your mortgage or a personal loan or any other non-super investments, if you're doing anything with money which is causing you to lose more than about 3 minutes of sleep at night, stop. You're probably taking too much risk. Sleeping at night can never be overrated. Being well diversified, investing in sensible assets, being aware of the kind of investor you are, how much risk you're willing to take, what your phase of life is. These are all the kind of questions that investors need to ask. And one thing I would say is if you're having trouble answering those questions, get some financial advice, either from an independent financial advisor or from your super fund who can certainly help you out.
Now, I will say on that, you literally took the words out of my mouth. If you do not have the capacity to invest additional money at the moment, you're already an investor.
Yep.
If you want to know more about what you're invested in, call your super fund.
Yep.
If you're an ART member, give them a call. Say, Brian said, call me. The call you and they'll say, "Who's Brian?" You're like, "You watch your mouth." But yeah, speak to your super fund. Learn and understand what you're invested in.
And I think certainly a lot of super funds, certainly we do, you can get online and actually get a very, very detailed listing of pretty much everything we own. Every stock holding, significant infrastructure assets, real estate assets. There's pretty much a very comprehensive listing of what assets you own as a super fund member. Well worth a read, and we keep that regularly updated.
Love it. Well, we might leave it there. Anything else that you want to add that maybe we didn't talk about or I skipped or that's been on your mind?
No, that's about it for me. I think apart from the fact that you haven't disappointed with the coffee again, you know.
You're welcome.
Here's a man that prides himself in his coffee, so certainly the best coffee on the Central Coast.
And weirdly, not weirdly, just a bonus thing for those that have listened for a long time, I think later in the year, we're going to have Jodie Fitzgerald join us from ART, who I've also known for a long time, and she's been on the podcast many times.
Absolutely.
And she's fantastic.
She is a force of nature. She'll do a fantastic job for you because very impressive human being, Jodie.
Yeah, love it. Well, thank you so much to ART for supporting what we do here and this episode today. Thank you, Brian.
Thank you, Glenn.
For jumping on.
Privilege.
If you've got any comments, questions, concerns, complaints, you know where the bin is, people. My name is Glen James, and this was Money, Money, Money. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.